So you're thinking about starting a real estate business. You've noticed the billboards along the highway, watched agents cruising around in expensive cars, and heard the stories of people who bought a couple of houses and were financially free by 40. Somewhere along the way, you've started running the numbers in your head. Here's the problem. The numbers most people run are wrong. Not a little off, completely off. What you see from the outside of this industry, the sold signs, the open houses, a 5% commission on a $500,000 home, barely resembles what the business actually looks like once you're inside it. That gap between perception and reality is exactly where most newcomers lose everything they put in. Before getting into the money, it helps to agree on what we're actually discussing, because real estate business isn't a single thing. It's really at least 7 distinct businesses, each with its own cost structure, its own risk level, and its own way of generating income. The first is the brokerage, the company that partners with agents who represent buyers and sellers, taking a share of each commission earned. It requires relatively little starting capital, but the income it produces is highly unpredictable. The second is direct property investment, buying buildings, holding on to them, and letting them appreciate while a tenant's rent chips away at your mortgage. The third is property management. Here, you don't own the buildings at all. You simply operate them on someone else's behalf, collecting rent, coordinating repairs, screening tenants, in exchange for a monthly percentage fee. Of all the models, this one tends to produce the most stable income. The fourth is development, acquiring land or a rundown structure, building or renovating it, then selling it for considerably more than was spent. This is where the largest profits are made, and also where the biggest failures happen. Beyond these are wholesaling, house flipping, and building a rental portfolio. Each runs on its own set of numbers, and each can wreck you in its own unique way if you go in without understanding how the economics actually work. When most people say they want to start a real estate business, what they usually mean is a brokerage. So that's where this breakdown begins. But by the end, you'll see why the most successful people in this industry eventually shift away from selling and toward owning. Where the money actually goes. When a house sells, the proceeds don't move directly from the buyer to the seller. They fragment across an entire web of businesses before anyone walks away with cash in hand. Take a $5,000 home sale in a typical U.S. market. The instant the sale closes, a chain reaction kicks off. First, whatever mortgage the seller still owes gets paid off in full. That money goes straight to the bank, not to the seller and not to the agent. Then the government takes its share. In the UK, stamp duty on a property at this price can reach 5% under standard rates. In parts of Australia, state transfer duty typically runs between 3 and 5% of the sale price, and foreign buyers face an added surcharge that can push the total as high as 9%. Next, the professional service providers collect their fees. The title company, which certifies clean legal ownership, charges somewhere between $1,000 and $3,000. The closing attorney takes another $500 to $1,500. The appraiser, who confirmed the home's value earlier in the process, collects between $300 and $1,000. Then come the real estate commissions themselves. Following the National Association of Realtors settlement in August 2024, the typical combined commission in the U.S. now sits around 5.7% of the sale price, roughly $28,500 on a $5,000 home. That amount is split between the two brokerages representing the buyer and seller, and along the way, everyone else who touched the deal. The lender, the inspector, the stager, the photographer, the contractor who fixed a broken step, has already taken their cut. One single transaction and a dozen separate businesses get paid before the seller sees a dime. What it costs to even get started. Now picture trying to become one of those businesses yourself. Here's what the startup costs actually look like. Licensing comes first. Anyone opening a brokerage needs an active broker's license, which means pre-licensing coursework, a state exam, and formal business registration, costs that range from $500 to $3,000. Then there's errors and omissions insurance, the professional liability coverage that protects you if a deal goes sideways and a client sues. Expect to pay $800 to $1,500 a year for that. After that comes office space. A traditional brokerage needs a visible, professional location to attract both agents and clients. In a mid-sized American city, that runs $2,000 to $8,000 a month, depending on the neighborhood and square footage. Technology is next. A customer relationship management platform for tracking leads costs $25 to $300 per user each month, and setup alone can run past $1,000. A professional website with live listing search functionality costs $1,500 to $5,000 to build. Add accounting software, document management, and e-signature tools, and the full technology stack adds several $1,000s more every year. Marketing follows: digital ads, social campaigns, physical signage, and local brand building. For a new brokerage, that realistically costs $6,000 to $24,000 in year one alone. Where the revenue actually comes from. Assuming a business makes it through those early losses, here's where its income actually originates, and which sources matter most for long-term stability. Sales commissions are the most obvious source. The brokerage takes a percentage of every closed transaction, keeps part of it, and passes the rest along to the agent who handled the deal. On a $5,000 home with a 2.88% listing commission, the brokerage collects $1,400. At a 30% retention split, it keeps $4,320. After franchise royalties and overhead are factored in, the net profit on that single deal is often under $2,000. Multiply that across 100 transactions a year, and a brokerage might generate roughly $2,000 in retained gross commission against annual overhead of $12,000 to $2,000. The margin is razor thin. Rental placement fees are a second income stream. When a landlord needs a tenant, the brokerage markets the vacancy, screens applicants, and finalizes the lease, typically earning a fee equal to 1 month's rent. On a $2,000 a month apartment, that's $2,000 for a few weeks of work. Property management fees are where the real defensive income sits. A management company typically charges 8 to 12% of gross monthly rent to handle day-to-day operations, tenant relations, and maintenance. This money comes in every single month, regardless of whether any homes are selling. A firm managing 100 properties at an average rent of $2,000, charging a 10% fee, brings in $2,000 a month, about $24,000 a year, entirely independent of the housing market's ups and downs, following one transaction from start to finish. Let's trace exactly what happens to the money in one standard deal. A house sells for $5,000. Total commission at 5.7% comes to $28,500. The listing brokerage receives $140,400, and the buyer's brokerage receives the remaining $140,100. Out of the listing brokerage's $140,400, the company keeps 30%, $4,320, and pays the agent the remaining 70%, or $180. After a 6% franchise royalty, about $259, and a share of overhead costs, the brokerage's actual profit on this one deal lands somewhere between $500 and $2,000. On the agent side, that $180 gross split shrinks fast. Professional photography and drone footage for the listing cost $1,500. The paid ads that brought in this particular client cost about $1,200 to attribute. Fuel, vehicle wear, and licensing fees add roughly $550 more. That leaves about $6,330 before taxes. After self-employment and federal income taxes, roughly 30% for a freelance agent in the U.S., the agent walks away with about $431 from a $5,000 transaction. The luxury market myth. There's a common belief that the luxury segment is a shortcut to wealth. Sell bigger houses, earn bigger commissions. The reality is far messier. Properties priced above $5 million in top markets like Miami, Beverly Hills, or London commonly sit unsold for more than 150 days. The most exclusive properties can take a year or longer to move. Compare that to mid-market homes priced between $3,000 and $6,000 in active American cities, which turn over in a median of about 53 days, and in hot markets like Austin or Denver, that drops to under 3 weeks. Trust is the real product. At its core, the real estate industry is a customer acquisition business. The property itself is almost secondary. What's really being sold is access to trust, the confidence that when someone is making the biggest financial decision of their life, they're in capable hands. Building that trust is expensive. A brokerage operating at scale has to run campaigns across several channels at once. Social media ads to reach people who aren't actively house hunting yet. Google search ads costing $5 to $15 per click in competitive markets. Local billboards and signage for neighborhood brand recognition, and open house logistics involving printed materials and digital follow-up. Nationally, the average cost to acquire a paying client in residential real estate runs around $791. A real estate website might draw 1,000 unique visitors a month, of which only 1 to 2% ever become actual clients. A brokerage handling 50 deals a year can end up spending $4,000 or more annually just on paid advertising to generate those clients, and that spend guarantees nothing more than the chance to start a relationship that might not close for 6 to 12 months, assuming the inspection goes fine, the lender approves financing, and the deal doesn't collapse for any of the dozen reasons deals fall apart. The ongoing costs that eat away at margins. Even with solid revenue and a growing reputation, real estate business owners deal with a constant stream of costs that squeeze margins month after month, and these are the costs that do the most damage during slow periods. Office rent doesn't pause just because the housing market cools off. Staff salaries continue no matter the transaction volume. Software subscriptions bill monthly, whether the system is producing deals or sitting idle. Professional liability insurance is due annually without exception. For a mid-sized brokerage, basic fixed monthly overhead, rent, utilities, base salaries, software, insurance typically runs $1,000 to $25,000 or $12,000 to $3,000 a year. That has to be covered before any profit is made at all. Structural risks that arrive without warning. The biggest risks in this business tend to show up with little notice. Chief among them is an interest rate shock. Real estate purchases are almost always financed with borrowed money, so any meaningful rise in borrowing costs immediately shrinks the pool of buyers who can afford to transact. The rate cycle that followed the pandemic in the U.S. illustrated this clearly. As the Federal Reserve raised rates to fight inflation, the standard 30-year fixed mortgage rate climbed from under 3% to above 7%. The monthly payment on a $4,000 mortgage at 3% is about $1,686. At 7%, the same mortgage costs about $2,661 a month, nearly $1,000 more for the same buyer, same home, same price. So, is it worth it? Here's the honest answer. It depends entirely on which of these businesses you're running and whether you understand the economics before you jump in. The upside is real. There's no real ceiling on income, no structural cap on what a well-run real estate platform can generate. The business scales through systems and people in ways most service businesses simply can't. And direct property ownership can build generational wealth through compounding appreciation, tax-advantaged cash flow, and debt that gets paid down quietly by someone else's monthly rent. Ultimately, the line between failure and success in this industry almost always comes down to whether the owner went in understanding that commissions are just the starting point. The businesses that build something lasting use brokerage income to fund property management portfolios, use property management fees to get through slow seasons without touching their reserves, and reinvest transaction profits into direct asset ownership structured around smart tax planning. They build their reputation year after year until referrals arrive faster than any ad campaign could ever produce leads. The biggest fortunes in this industry were never built by selling one expensive property. They were built by mastering the economics of an entire business, and then using that business to create something that keeps paying long after the last deal has closed.